Okay, let's start the recording. They will still be talking about the Elliot wave. Okay. Elliot wave. Okay. So Elliot wave is always it's still the same thing. It consists of 3 pushes, 2 corrections, and a retracement. That's still the same as structure. Okay. First thing that will have to happen first, the trend. Let's say we are coming from a downtrend. So the trend stops right here. The downtrend stops. So immediately we have to enter an in and uptrend. So first we have to have first push, and let me turn the trend line going up to blue, so as you can know that we are in an uptrend. So first is the first push. So when you have the first push, then you have to have a retracement of at least 618. Okay, of 6. Most times it's always 618%. So if you plot your fib, it's gonna be 618. Okay, 618. So let me write that out. So prices, it will retrace to 618. Of 618, 61.8%. Okay. Then after the retracement I'm going to explain this more using a live chart. So I just want us to understand the Elliott wave theory and the basics first. So after this, we have to have the next push. This is the first push. This is the correction. Okay. Then this is the second push. This second push is always the longest of all. It is always the longest. Upon the second push, then we have another correction. Remember, we do have 3 pushes. Okay. At least in a structure, we have 3 pushes. 3 pushes. Got 3 pushes. Got 3 pushes. 2 correction at least. It can be more, but this would always happen every time. 2 correction, and we have a retracement. And this always at 50% retracement and a retracement. Okay, this is what is happening for. This is what happens for a structure to be complete. Okay, you welcome Mr. Godwin. For a structure to be complete, this is what always happens. So first, we've got so the trend has got to be coming from an uptrend. Was coming from an uptrend, then from a downtrend. Now we have to continue with an uptrend. So first we have a first push, and we have a correction. We have a second push, which is always the longest. Then the next thing is for us to have second correction. Upon the second correction, the correction must not be, for this correction to be valid, for the structure to be valid, correction must not break out this one. As a matter of fact, let me label them. This is 0. Remember, I call it the Elliott wave 5 pushes. There are 5 waves, rather. There are 5 waves. This is called 0. This is 0 point. And this is 1. This is 1. And this one will be what? Just unmute yourself. I will just want us to talk. Can I unmute yourself? This level, this point will be what? What point is that? V2.
On 2.
Yeah, perfect. Okay. Then this will be the next point, and that is point what?
That's point 2. Is it 2?
It's 3 now. We just did 2 right here.
Oh, yeah.
Yeah, 3. So, and this second correction will be what?
4.
Perfect. So this is 4. And the last would be what? The 5, the fifth one.
5.
So it's going to be like this. So this is how the structure, this is how market move every day. So now let me explain more further on how you have to take advantage of it. Okay. So now I said earlier, this line that I put here, you can see this line that I put here is a new support. Because first, market moved from 0.0 to 0.1, forming the first push. Okay. Right here, it formed the first push, P for push. Okay, boom. So when it move, you have to retrace because markets don't run in straight way, move in wave. You have to run, rest, run, rest, run, rest, run, and rest. Okay. So it moved from 0.0 to 0.1. So when you get to this point, it has to rest, take a rest. So at this point, this one is now forming a what? A resistance. So there's a line of resistance to this point. So it's finding it difficult to break this point. So you have to put a line of resistance right here. So what happened? It rested. And when it rested, it came back in here and it broke it. Immediately broke it. It is no longer a resistance at this point again. It is now a support for this point. So for this particular line to still be valid, for this particular structure to still be valid, this 4 must not break this particular resistance or a support. Okay. Now let me come again. From 0.0, it runs to 0.1. When it gets to 0.1, you have to rest. So resting will make you to form 0.2. So this is from 1 to 2 is called correction. It's correction. Okay. From 0 to 1 is a push. So from 2, after correcting, this is where you have to buy. Okay. You enter in for a buy.
Oh, okay.
Yes. You enter in for a buy. Remember, I said the longest move is always from 2 to 3. That's the longest move.
Okay. So my question is, how about if you enter in at 2, right? And you say this is resistance on that line 1. You enter on 2 and it goes and hits that resistance and comes back down.
Okay, and comes back down.
Instead of going up. Yeah.
Okay, instead of going up. Okay, perfect.
Yes.
Okay, that's the reason why you have to be very conservative. Once you enter in here, you put your first take profit right here. Okay.
Okay. All right.
Once it breaks again, you can enter in for another buy because very sure it's going to break past this level for it to form another resting point. That will be another support, which is this one. It can stop at this point, it can stop at this one, but it must definitely be above this 0.1 for the structure to be valid. Okay.
Okay.
All right. So from 0.2, it goes to 0.3. And at 0.3 is always the longest. So I always advise you enter in here because you might not always catch this 0. You might not always be able to buy the very lowest of the market at all times. So in order not to risk your money, I always advise you wait for this 2, for this 0.2 before you enter in for a buy. So once you get here, you exit. And once you see it break past this resistance, support resistance line, then you are going to enter in for another buy. Okay. All right. So once you get to 0.3, it's going to have a correction again. So the correction will stay above this line. The correction can come from here, from this point to about this point and go up, or it can just come just so as long as it did not break this resistance line below. It is valid as long as it did not break that resistance below. So from 3 to 4, the retracement has to be 38.2 to 50%. So I'm giving you this number so you know where you are currently in the market. 38.2 to 50%. Okay. That's the fib level for that point. I'm going to prove everything to you with live chart. So once you plot your fib from this point to this point, then once it's getting to 38.2 or 50%, you know that the market will soon reverse and continue the normal trend, that the correction is over and continue the normal trend. So it gets to 0.5. Sometimes it might not always get to this 0.5. Okay, this is what would likely happen. And let me draw another one. There's what we call truncated 5. Truncated 5 is a scenario where the last push, this third push, or this 50 line never gets to move above this 3, this resistance. Remember, there's also a resistance right here. This red line, they are support and resistance line, support and resistance line, support and resistance line. Okay. When it gets here, it rested, it came back down. Then it come here, it could likely break and might not break. Now, let me draw the truncated, another instance. Okay, let me make this red so you know it's all a magenta. Let me make it a magenta so you know there are different ones. These are two examples that could happen. It could actually get here and reverse and come back down. Okay. And come back down. This is what will likely happen. So if it gets here and come back down and you buy here, remember I said you buy here, set your first take profit at this resistance part, okay, you are not hurt. So you hit your take profit and you are out of the market. So you are waiting for it to break successively above this resistance line so you can enter in, you have a next confirmation, you enter in for a buy again. So once it hits your first take profit, you have to wait for it to break. So if it did not break, you don't enter, you wait. All right. So in this case, what happened? Why did the market have to come back down? Is what we call truncated 5. Let me write down truncated. These are very, very important because this is how the market works. Truncated 5. Truncated. Okay. Let me make it magenta. Truncated 5. Okay, this is what we call truncated 5 once it does not work. So this point would be 5. In either case, to be 5. Then didn't get to. This is where the last push failed. This is an example of where the last push failed, but this is an example. This blue one is an example of where it worked out successfully. Okay. This one do work when we're in a strong trending market. There are times we're in a very strong trending market, most especially in Euro USD and GBP USD. We do have, I've seen a scenario where we have 6 pushes. Yes. Move, push, come down, push, come down 6 times. It did that 6 times before correction. All right. So after that, we have a retracement. You can see we have got 1 push, 0 to 1 is a push, 2 to 3 is a push, and 4 to 5 is a push. Then 1 to 2 is a correction, 3 to 4 is a correction, and a retracement. Then we are going to have a very good retracement of 50%. Retracement, boom, to the downside. 50% of this whole move to the downside. So let me make this one red. I'm going to explain if it's still clearer. I'm sure you guys are following. Do you understand to this point?
Yes.
Okay, perfect. I'm doing a recording. You can watch it on over and over again. So what do I mean by all this one? This retracement you see right here is such that if you take your Fibonacci from 0.0 to 5, then your 0.50, the price comes down to at least 0.50%. That is the meaning of that Fibonacci. Okay, now let's take a Fibonacci, though we are not on a live chart, but from here, if you take a Fibonacci from that point to the highest, to the 5, then the retracement will get to 50 at least. So let me move this. Okay, it will get to this 50. You understand?
Yes.
So that's this big retracement. Does that mean the trend has changed? No, it has not changed. Only retracing, a big time retracement, because it moved up, it moves significantly to the upward side. So you have to come back and retest the 50% of the whole move. Okay, that's the Elliot wave theory. All right. So let me delete this Fibonacci because sometimes it make the chart look so complex and messy. All right. So that is just basically Elliot wave theory. It is very simple and it happens all the time in the chart. And why is this very necessary? So as you know where you are currently in the chart, so you don't get caught up in buying in the wrong place. Let's say, for instance, you started buying, you started selling at this point, you'll be wrong because you see this whole move to the downside, and you started selling at this point. It's going to be very wrong. Okay, and let me come again and explain the whole move. From 0 to 1 is a push. From 1 to 2 is a correction. 2 to 3 is a push. 3 to 4 is a correction. 4 to 5 is a push. Or to this part is a truncated push. If you didn't get to break this resistance, is a truncated move. Note, while this price is coming down, it might not just come down straight. If you come down straight, there's what we call simple move. Okay, there's a simple and a complex move. There's what we call simple or a complex move. Simple or complex correction. Simple or complex correction. Simple or complex correction. Let me just put it right here. We have a simple correction if the price just move in series of red pam 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 down without having blue on it. Okay, you have a complex when you have just a series of red candle just move down to hit your point 2. Okay, then most times you only have a simple move in your 1 to 2. Sometimes you might not always have a simple move from your 3 to 4. You might have a complex move. Now let me explain a complex move. A complex move comprises of A, B, and C. That's where we have the harmonic structure. Okay, the harmonic structure. Then the second move this one has to be come from 3. Okay, it's a small structure moving. So you have a high low point. It goes up. Okay, comes down. That is what it does. This is what we call complex move. Okay, it will not just go down straight. You have to go perform point A such that it will have this point will be A, point A, which is forming harmonic or these harmonic patterns. Let me make this small. Make about 14 because it's very small in your chart. I'm going to show you everything to you right away. This will be A, and this is going to be B, point B. Okay, ABC correction, and this will be C. You might not have heard these things before, but as time goes on, as you grow in Forex, you're going to understand what this thing I'm doing, because this is the basics of Forex, basics of fundamental analysis. If you understand this, I promise you won't get caught up in any wrong trades so often. Okay, so what does this mean? When it comes to see that the price is going to go up, so it agrees with this. Upon the C correction, it is corrected, it is completed. You have from this point to A to B, B to C, then the correction is over, then boom, to the upside. It has to obey this bigger move. All right. Okay, now all these things that I've explained, that's how everything, and the correction too. The correction might not just go down, boom, too. Okay, the correction, it's correct in waves too, because market do not move in straight way. It corrects in wave. The correction could go like in this form, come down. Okay, have a high, come down too. Okay, such that still give you the same place. This point is point A. Why this point is point B? ABC correction. Harmonic spot distance. So you don't have to be drawing distance all the time. I'm just trying to explain the heck. You have to draw all these things because we have all the tool that does all these things. I'm going to tell you how to figure these things out and use it to our best advantage. If not now, maybe in the next webinar, because that's what we have been doing all these days. The next webinar. So let's try and understand this. Screen grab this. Okay, we have a recording. Okay, you can screenshot it. Make sure this whole structure is always in your head. All right. So now let's go to the live. Let's move up and apply it to our live example, our live chart. Boom. So now here is what, okay, now let me erase everything and start afresh. I'm sure you guys are following. Do you understand to this point, that explanation?
Yeah, I'm following.
Okay. Anyone on again? Are we following? Mrs. Tolu, are we following?
Jeff, I'm with you, but I would have to pay attention to the recording because I'm going to pick my son from school now.
Perfect. Okay. So now here's it. Here's the whole deal. But wait, I want to clear up the chart. So that's why I'm still trying to take my time to make sure. So now here is on the daily. You can see this same move that we've been explaining right here on the daily. You can see first, as I said earlier, the first line I drew while we're here on the was a line that is coming from an opposite direction, and which is the opposite direction. Since we are talking about a downtrend, we're going to be focusing on an example coming down. Is the opposite direction will be up. So first we have a move to the upside. So that is where this and this pushes this one Elliot wave theory for the buy zone ended here. Now we're on a sell zone. You can see this arrow, but don't pay attention to the arrow first. So now for that, you have to come here. First push from this point to this point. That's the first push. Remember, I said from the first push, you might not always get to buy the top or to sell the top or to buy the bottom. You have to just let this move go. Just accept that. You have to let this move go. Okay, first we have this first push to the downside. Then what I'll be expecting next is a retracement. And that retracement has to be 618 of this first move. Now let's plot out our fib levels from this point to this low. So it has to be at least, zoom in, it has to be 618. And make sure it touches the low from this point. Okay, you can see the retracement touched where? Can you unmute yourself and just talk? You can see this, it touched, maybe, did you see that it touched 618?
Yes.
The candle that retraced, perfect. So we are going to take our next, use a correction, it corrected to 618. So now we are done with that fib level. So what do you do once it's corrected to 618? You sell, you start selling at that point. Once you see a candlestick reversal. And which candlestick reversal did we see? We see morning star. You see a red, you see a bullish candle with a doji and with this. So it's telling you to sell. So you can get in a sell. This is on daily anyway. It happens in every time frame. It's irrespective of any time frame. Elliot's wave theory happens on all time frame. So just pay attention and don't be worried about the time frame, okay? So from this point, we have, this is point 1, 0. Now let me label them just as I label on our, here's point 0. Okay, from point 0, we go to point 1. First push to point 1. So this is 2. This is 2. So what's the next thing? From 2, we need a next push. And that push came to this point. You see, it's always the longest. I told you that from point 2 to 3 is always the longest. So you want to enjoy that very powerful ride. Okay. So you would have gotten in here for a sell and you enjoy it. Now let's calculate the pips. If you had entered from the top to this point, that'd be 586 pips. Okay. 586 pips. Just understanding this Elliott wave theory alone. Other confirm. Okay, that's 606 pips rather. I didn't get down. Okay. So after that, you have the next push up. The next push up, sorry, next correction will be from 3 to 4. So this will be point 4. That's your point 4. So from 4, you have what? The last push. On the fourth correction, you have the last push. Okay, we don't know if it's the last one yet, not until you get a very nice correction. So how do we get this point 4? How do you know if this point 4 is finished correcting? You pick up your fib level. Okay, you draw from the last high. This is the recent to this point. Remember, this was the last high, right? You draw from this one to this point. And what do we say the percentage has to be? We said it has to be 38.2 or 50. You can see it retraces to 38.2. So at this case, you know that yes, it has finished retracing. Then you get in again for a sell. You get in here for a sell. You trace it. This is how I do mine. I throw in for a sell. I put my take profit right here on this low. this resistance. This is my take profit. Let me turn the line to blue. I'm going to remove the fib and you understand it clearly soon. Okay, the blue my take profit. Remember, I entered in here too before for a sell. I enter in right here for a sell. My take profit was on the previous low. Then this thing, I will enter in right here for a sell. Let me turn this one to red. Okay. So now let me eliminate the fib. So this was my first entry. We enter in right here after the first correction. This thing hits 618. Okay, I know. Okay, now it's over. For you to start selling, this correction is over now. We need the next push. So I'm going to enter in to write the next push. So this will be my first take profit. Now let's calculate from this point to this point. That's 201 pips. Okay, got 201 pip right there. It's 101 pip. For me, that's 2001 pip because I use a standard lot. That's 2000. Then I jump out. Then the second position, I enter two position. Then the second position is still running, still taking me down because I use a smaller lot for that. Still taking me down because I'm expecting to ride to the end to 5. So that one is still running. I jump out from the first one just in case it reverse. Then when I get here, the market it pushes back again. It retraces to about this point. Then I plot my fib again from 0.2 to 3. So from 0.2 to 3, then I'll be watching for the levels. You see that it hits 38.2 or 50 before I jump in, and I wait for a candle pattern. You can see a bearish engulfing. This candle engulfed those two previous bullish candle. So I'm going to jump in again for a sell from this point. Now let me move this red to, okay, let's say upon the close of that, I drop in for a sell. So when I drop in for a sell, I use this one as my take profit. This the previous low as my take profit. So upon the break of this previous low, then I know that let's say that it will still go further down. Okay, it will go further down. So first I take my profit, then that last one, the previous one is still running. So now let me calculate the distance from that place to this point. That's 158, not much. 154. Okay, got 154 right there. That's how you just gather, you accumulate your money. You accumulate the money, the cash. Okay. This is just with the knowledge of Elliot wave theory. Then you're still riding. Then this big one that you have been riding, you've been on this one for a very long time. Let's calculate now. By now, you should still be in profit, 868 pips that you've gathered from that. That's how you have to trade wisely. 868. Okay. Then if you sum everything up, I'm telling you, it's gonna be the bomb. All right. So that's how basically you use the Elliot wave theory. Now let's go from this thing I've drawn. You can still see it will still tally with 4 hour and on 1 hour. All right. So on the 4 hour, let's go there and see what's happening. Boom. So let me shrink this. You can see what is happening on the 4 hour. You see, it still expected it. Okay, let me delete these lines, this entry line, my example of how I enter and how I do my stuff. Okay, so now let's go to right to the top. You see where it started from the daily. We drew this thing from the daily. You can see it's still expecting on the 4 hour. This was the first push, retracement, second push, retracement, third push. And right there, we have it here. So what are we expecting? This is why I call E-card for a buy, a long-time buy. You can see, what are we expecting? We're expecting a very huge retracement to at least the 50%. Let me go back. Let me come back again. Okay. The retracement we are expecting now, since this structure is complete, so we're expecting a retracement. The retracement we are expecting to 50%. That's what we are expecting from this point, the overall fib. So we're expecting this price to go to the 50%. That is what we are expecting from this point to go to the 50 for a correction. Okay, that's what we are expecting on Euro card on daily. So on 4 hour, we are still watching. So this is what we are watching. So that's why you can see this long move. Okay, that's how you keep riding all day long. You can see the first push on 4 hour has already been established. You can see from this point, I'm talking about the buy now. From this point to this point, let's see if the correction is over. Let's draw our fib level. For you to know if the correction is over, what level, how many percent do you have to? Now I'm gonna draw this, and you explain to me. So for you to have your second from this point to this point, this one is coming from daily. Let me delete this one so you understand. So I'm going to use this blue from this point to this point. I'm going to turn to blue so you know on the 4 hour. We are on the 4 hour. This one is drawn on the 4 hour. So just unmute yourself because I want to ask a question right now. So how do you know if this correction is over? Who is on? Want to give it a try? For the first correction to be over, where does price has to get to on our fib level? Where does price has to get to? Where does price has to get to for this first correction? Okay, you can still look at this one. For the first correction, where does price has to get to? For you to have your two established, where does price has to get to? Okay, like no one seems to be still confident about it. It's very easy.
38.
Perfect, 61.8, right? Yes. So for you to have your second one, you have to come to 61.8. So now let's go to see if it's correct. If it ever got to our 61.8, yes, it hit our 61.8. So this is 61.8. Hit 61.8. Moving it round, really looking messy. Okay, from this point, from the first push, we had the first push. Then for you to know your correction is complete, you have to come to 61.8. This is the line of 61.8. So we already have our correction. So what are we waiting for now? This is first correction. Then we are waiting for what? Expecting the next push. So the next push must be higher than this previous high for it to have a successive uptrend. So you have to go up higher. It's either this point or to this point or to this one. For it to be high, it must be higher than this one. So what do? You get in for a buy, right? I call this one for a buy already. We're already in. We have been riding it. Started from about when it was so small. That's when I call it. Right now we are on 28. We should be on 28 pip profit. Okay, that's 180 pip only. Okay, so we are still riding on that. So that's how you just use it. How can I get rid of this fib now? Okay. What's the last Fibonacci? Gotcha. Okay, so that's how you get this one. So this one will get to this point. Once you get to this point, we are expecting another correction to the downside. The correction must not take out this one. It must come to this point. You can see automatically to come to this downside. To come to this downside, how do you know if this correction is over? You bring out your fib level again. You have to take from the last low. This is the last low. If you are buying last low, if you are selling last high, take from the last low, take it to the current high. Okay, it must touch your 38.2 or 50. So it will play around this level, this 38.2. You can see 38.2 or 50. Okay, upon these two levels, you have to wait and watch closely for a candlestick pattern, a reversal. Is that a bullish engulfing or a vectoring? I explained what vectoring was in the other time. Is the other time rather. So you're waiting for a vectoring, an engulfing, a morning, an evening star. Okay, any of those, tweezer bottom, any of those candle reversal that you have learned on JCP application. So, but it must get to this 38.2 zone and 50 zone. I'm not 618. Okay, 618. You know, it's not. It just probably just reversed. So once you get to this point, you delete the fib again. You enter in for a buy. Once you get into that point, boom. Then you're having a fifth move. Okay. That's how you ride all on and on and on. So that's the whole thing you need to know about Elliot wave and the theory. So now let me just get rid of everything, and now I'm going to explain and announce something more exciting. And you guys need something that will make everything more simple and more easier. Yes, we've got all of that, all of those on Fire Team. Okay, you remember we have support and resistance for the one that draws support and resistance for you. Okay, so you don't have to start bothering yourself. Remember, the first move was from, I said, for the first push to be established from this point to this point. So this first push, one is a resistance level. You can see this line, this yellow dotted line right here. What did it say? Resistance on H4. Okay, so you don't have to bother. So you know that now it's a correction. It gives you the resistance. So now it comes right down. This was also a resistance on H4, telling you that the move started from here to this point. Then it corrected to the, now you have to have a new correction. So it corrected. Remember, once a correction can never take out the previous low. This is the lowest. And it goes to the high, form a low, form a high. So now the next move we are to be expecting is to come to this resistance. Okay, from this point to come to this resistance. So once you come to this resistance, then we will be expecting another correction. So what resistance is this? Resistance on daily, right? Are we on? Resistance on daily. Maybe probably busy, no problem. You can just go on the recording much later. So this will be resistance on daily. So on and on. So the last move would have to come to this one. This is support on weekly, or support and resistance on weekly. So come. So that's how you use the support and resistance on our theme. On the one we have on harmonic fire to use it to your advantage. And which indicator controls that? It should be B. Okay, the B indicator. This one right here. You just drag and drop. You can see everything's already fully automated. You drag and drop on your chart. Now let me delete it and start afresh. I added it before. So you see there's nothing, no lines, no support and resistance. So I just drag the B indicator on my navigator toolbar and I drop it and I click OK. You see everything appears automatically, drawing it from daily, weekly, all time frames. Drawing it for me, hand-free. Okay. So that's what that does. Then the next thing is the Elliot wave. You might be asking, I don't really understand the Elliot wave yet, and not so fast now. We have got another indicator that does that too. It is the zigzag indicator. It draws the Elliot wave for you, but it is not as accurate as you drawing it yourself. This is the Z. Okay, it's controlled by the Z. You drag here and you drop, you click on OK. Pum. That's the Elliot wave. Can you see this line from this point to this point? Although it's spot all the smaller moves, but you have to pay attention to the bigger ones. You see this line? Okay. Now let's go on daily so you could have a very good and nice view to it. You can see on daily point coming down. This was our first move to this side. It came here, you bounce, came here, bounce, came here. That's how it works. You can see on an uptrend to move straight up on 4 hour. Still on the same, but it's more better that you understand the structure yourself, because these things are coded based on the programmer's knowledge. Okay, that on 4 hour, the first push was from this point to this point, and correction from this point to this point, a correction. Then we have the last one. Boom. So you see this one. So you don't have to pay attention to these smaller moves. You have to pay attention to these smaller ones. So the main one right here is we have less than 1 minute, so this meeting is going to be over. So that's basically much it. So I'm going to be sending a new link for us to join in once more, so we can take live trade. I'll call it a day. All right. Thank you.
Hey, thank you.